Hi, everyone. Today we're going to talk about IFRS 15, which is all about revenue from contracts with customers. I'll keep it simple and focus on what you really need to know for interviews. We'll go over the main principle, the five-step revenue recognition process, and I'll share some practical examples along the way. So first, what is IFRS 15? Well, it's the standard companies use to decide when and how much revenue to record. The main idea is to make it clear when revenue is earned and how much the company expects to receive. The main rule is actually pretty simple. You record revenue when the customer gets control of what you promised and for the amount you expect to get paid. For example, imagine a furniture store delivers a sofa and the customer accepts it. That's the moment you record the revenue. It's not when you loaded it onto the truck, and it's not when the customer eventually pays. It's when they can actually use it. Now, IFRS 15 has a five-step method to make this easier to follow. Step 1 is to identify the contract. Basically, make sure there's a real agreement between you and the customer. Step 2 is to identify the performance obligations. This just means figuring out exactly what you promised to deliver. For example, if you sell a laptop with a 1-year warranty, there are actually two promises, the laptop itself and the warranty. Step 3 is to determine the transaction price, or how much money you expect to get from this contract. Step 4 is to allocate the price to each performance obligation. So if the laptop is $950 and the warranty is $50, you assign those amounts to each part. Step 5 is to record the revenue when each obligation is fulfilled. So you'd record the $950 for the laptop when it's delivered and the $50 for the warranty gradually over the year. Sometimes, revenue is recorded at a single point in time, usually when the customer receives the product and gains control. For example, delivering a TV, the revenue is recognized right then. Other times, revenue is recorded over time, when the service is provided gradually. For example, a yearly subscription costing $120 would be recorded as $10 per month, or if a construction company is building a bridge over 12 months, revenue is recorded each month as the work progresses. Here are a few real-life examples to make it clearer. Imagine a software company sells software along with training. The revenue for the software is recorded at delivery, but the training happens over time, so that revenue is spread out. Or a streaming service with a yearly subscription, revenue is recognized each month as the service is provided. Some common interview questions you might get include: what are the 5 steps of IFRS 15? How do you identify performance obligations? What's a standalone selling price? When do you record revenue at a point in time versus over time? How do contract changes or discounts affect revenue? If you want the answers to these questions, type answers in the comments, and I'll send them to you. Here's a tip for interviews. Always refer to the 5-step method. Give simple examples, and remember the signs that control has transferred, like legal ownership, physical possession, or the customer accepting the product. So that's IFRS 15 in simple terms with practical examples. Go over the 5 steps, think of a few examples yourself, and you'll be ready to answer interview questions confidently. Thanks for listening, and don't forget to like, subscribe, and comment if you want more simple IFRS content.